Good morning, everyone. I'm David Schollenberger, partner and head of the hotel team here at Healy Solicitors. Thank you very much for braving the elements today and coming out against all odds. Also apologize for the tardiness of the food and the video equipment, but again, it was related to the elements. I think we've got an exciting session today. Mike Saul, the Managing Director of Hospitality at Barclays, is going to be our moderator, and we have a distinguished panel that he will introduce. We'll try and, after a introduction to the topic by Anna Eck of Christie's, we will have a panel session. During the panel session, Mike will encourage discussion among the panelists and give some questions. If anyone has questions during the presentation or afterwards, feel free to raise your hand. We're a small enough group that shouldn't interrupt the flow too much. Anyway, I'll hand it over to Mike to start things off.
Okay, thanks, Dave. Just literally 10 seconds then over to Anna. I'll introduce the panel at the end of Anna's presentation, but I mean the question we're all asking today is investment opportunities, the European marketplace, and let's just set the scene by Anna giving us a bit of an introduction to that landscape, if you don't mind. Thank you.
Yeah, pleasure. Good morning, everyone, and thank you for joining us today despite the snow. My name is Anna Eck, and I'm an Associate Director at Christie & Co.'s Hotel Consultancy team across 30 European offices in, amongst others, Germany, France, Spain, and the UK. We advise clients with their hotel investments. Recently, we've launched a research report analyzing European travel trends and hotel investment hotspots. And today, I'm going to present you the risks and opportunities around European hotel investments that we've identified in this report. So, first of all, we start with a very positive message. Europe is the most visited destination in the world, attracting 628 million, or half of global arrivals in 2016. As demonstrated by the steady growth, as you can see in the graph, Europe has proven resilient to safety challenges and economic uncertainty that we faced in recent years. In 2016, the biggest share of international travel was to Southern Europe, which has benefited from displacement tourism because of political instability in the Middle East and North Africa. Going forward, we expect this positive outlook for Europe to translate into increased demand for accommodation. Accessibility is a key driver for tourism, and Europe's attractiveness has historically been supported by major airport hubs such as London Heathrow, Paris Charles de Gaulle, Frankfurt, and Amsterdam Schiphol. In 2017, the airports highlighted here handled over 500 million passengers. However, most of these largest airports have reached or are reaching capacity. Thus, our conclusion is that rather than the lack of demand, infrastructure constraints might risk the growth in Europe. Whilst we knew that inner European demand has historically been strong, our report reveals that European travelers account for almost 90% of the demand in Europe. That is, people from the UK traveling to Germany, Germans traveling to Spain. That is because some of the world's largest outbound markets are located in Europe as well, such as the UK, Germany, and France. So in order to understand what might drive the market growth in the future, we have identified the top international non-European feeder markets, such as the US and Canada, as well as emerging markets like China, India, and Brazil. So in order to provide an outlook on demand, we've been extremely privileged to work with Google Analytics data. They track more than you think. This data shows researches rather than bookings, but still provides a good indication of where people are looking to travel next. So the volume of searches is shown as the market share on the bottom, and the other axis shows the annual growth over the past 3 years. So the UK, all the way to the right, Italy and France are fairly established markets. However, we also see an immediate effect on France due to the attacks in Paris and Nice, impacting the number of searches going in for around France in the French hotel market. For Finland, up there, Norway and Portugal, on the other hand, it is fair to assume that based on this data, demand will grow in the future. So we know demand is strong. What does that mean for supply? Italy is the largest market with 2.25 million hotel beds in Europe, followed by Spain and Germany with just below 2 million beds. Iceland, Denmark and Finland are at the other end of the spectrum with 150,000 beds or below. The overnight to bed ratio that we're using here helps to understand demand in relation to supply. So a high O to B ratio, as can be seen in the UK, Ireland, Iceland and Spain, suggests room for new supply, while Greece, Italy and Finland show more saturated levels of supply. Seasonality constraints can be one factor to explain that, with demand being concentrated on a few months during the summer. So, when looking at European hotel transaction volume, the question is, will the UK hold on its strong position against Germany and Spain? 2015 was the strongest year yet in terms of transactions in Europe, reaching 27 billion euro. The UK accounted for over 40%, or 11.4 billion euro of that. This was mainly driven by large portfolios such as Jury's Inn and the Kew Green sale. 2016, on the other hand, saw transactions slow down in the UK, and due to the uncertainty surrounding Brexit, the German hotel investment market performed very strongly. Germany outranked the UK for the first time in terms of transactions, reaching 5.7 billion euro. In 2017, transactions in the UK picked up again, as large portfolio transacted again, such as Jury's Inn, which sold for approximately 900 million euro, and Kew Hotels, which sold for roughly 600 million euro. At the same time, Spain saw transaction volume more than double, from just below 2 billion to over 4 billion euro. So what does that mean? Where are the opportunities? Where will we see more transactions in the future? The black dot in this graph shows the current position of the market when factoring in the overnight to bed ratio and RevPAR performance. The arrow indicates the outlook, or our outlook, for 2019. For this, we've cross-analyzed our overnight to bed ratio forecast with RevPAR outlook, liquidity, and transactional outlook for each of these markets. So going forward, we expect to see more interest in less known destinations, such as Croatia and Romania, as investors are looking for value. We've also identified branding opportunities for Iceland, Poland, Denmark, Sweden, and Portugal. Due to growing demand, positive RevPAR growth, but low brand penetration at the moment. For opportunistic investors, markets must show good signs of liquidity and low prices per key in order to create value. Thus, we've also considered liquidity and the transactional outlook for each of these markets when identifying Portugal, Poland, and Sweden due to good RevPAR growth potential, fairly good liquidity, and low prices per key. Hopefully, this provided you with some insight on the European hotel transaction market. Thank you very much for your attention, and now I hand over to Mike and the panel.
I'll just stand aside for the panel to gather. Thanks, Anna. That really does set the scene. I think that one of the things that is coming out of the Europe and UK markets is that no one size fits all. It is very, very different according to where you're based. I think the other thing that seems to be coming out is that there is more demand than supply. So if supply is at less than 1%, demand is up at 3.5%. So there will be hotspots in terms of where new investment needs to go and where people need to place their money. So it would be interesting to hear from the panel their thoughts around the market as a whole. So to introduce the panel, and in your packs you have got a copy of their bios. I won't seek to read out the bios, but Corinne from Christie's, Head of Consultancy. Good morning.
Good morning.
David from obviously hosting us today, so thank you for that, David, from Healy's. Tim Helliwell, Head of Hotels at Barclays, so I know a little bit more about Tim. Bumju, Director at Transactions at Investco, welcome. And then, what else have we got?
Julie Fawcett from Cubic. I'll introduce myself.
Julie, yes. Sorry. This is what happens when the numbers don't quite work out. And then obviously Nicola from Kale Street Partners, really a real estate fund, I guess is how we define you. So please feel free to have a look in the bios in your packs. But I wanted to start off really, maybe Julie, you could talk to us a bit about, is it time to invest in hotels in Central Europe? And we'll start you off first for catching me out.
I feel you. Thanks. Is it time to invest in hotels in Central Europe? I think that largely depends on your perspective. There's very different places that you can come from in terms of why and how and where you would invest. And the perspective that we come from is effectively we're developing a new brand. And we need to create value on all of the three levels of the value chain in a hotel. So, starting with the property side, we are looking for some of the factors that Anna was talking about in terms of low in costs per key. We're looking for RevPAR growth potential, but we're also looking for an ability to provide additional traction with our brand value. So. Is it a good time to invest in Europe? Yes. Do those opportunities exist? Yes, absolutely they do. But Europe as a whole is not a homogeneous place, obviously. So there are definitely parts where are pretty much a no-go for us because some of those key factors just aren't in place. And there's some that's really, really interesting that largely is focused around the recovery of southern European markets is how we see it this year. And obviously the tableau changes all the time. And we all know that this is a cyclical world and there is going to be an impact in the UK from Brexit, and that probably will run through some of the European markets as well. So there's a lot that I think is going to change.
Okay, and Nicola, a good time to invest in Europe?
Yeah, I mean, look, on our part, we have a bit of a two hats because our fund invests both in equity and buying assets and investing in joint ventures. But we also provide financing to funds, developers on any project. So on the financing side, we tend to be a bit led by wherever the capital goes, and we'll look at by project. On the equity side, as Julie was saying, I think there's pockets of growth. We don't look at Central Europe, and we stick to more established markets. But we think that within those markets, there's interesting trends. City markets that was mentioned, like Madrid, Paris recovery, but also more like geographical pockets like Southern Europe, resorts in Spain, the Canaries, Greece, and also bringing more quality product in Italy, mainly Milan and Rome, which have a lot of rooms, but a lack of brands and a lack of established modern product, which we think offer opportunities. So we tend to look along those lines really.
Thanks. So on the basis that we accept that there's good opportunity in Europe, Corinne, maybe in terms of the advisory role that you're taking with Brexit in mind, what sort of conversations are you having and how is Brexit influencing some of these decisions?
What we've seen is, depending on the type of capital, people have shifted slightly from the UK, but quite few of them are actually coming back, which I think is quite a good sign. Starwood Cap acquisition for yesterday of Hilton, for me, is actually a good sign. They really have a strong, they really believe in the UK market. But what we're seeing is, opportunistic fund and PE fund that we deal with every day. They really look at now France to Spain to Belgium to Croatia. They shift every day. They're looking for opportunities and value creation. And for a moment, they've really moved. And you've seen really a spread across the UK in terms of the advice that we provide. So you have to be ready for the next market because it changes every week pretty much.
Yeah.
But that's what's exciting about it.
Thanks. Tim, in terms of lender appetite, Brexit, Europe as a landscape?
So I think if you look at the trends being capital from west to east. So, flush through from States into UK in 2011, 2012. As the UK market showed macro signs of recovery, I mean liquidity, both debt and equity went in incredibly quickly, frankly, and you saw from the slide that Anna put up how UK transaction volumes leapt up in 2015. It was the market recovered incredibly quickly. Germany aside, which I think was a market which has performed steadily and solidly, arguably got very liquid. It is very liquid at the moment. That market's been very solid. But you look at Spain, frankly, didn't really start to recover properly until 2014. But again, you saw 15, 16 waves of liquidity going into that marketplace, and recovery again is now coming through very, very strongly. And I think now we're seeing Italy again starting to recover. 16, we're seeing a lot of liquidity going in 17, and that is now moving east. So investors in searching for yield are now going to they're now looking into Central and Eastern Europe, and indeed the liquidity is following to the extent that we're seeing from the investors we talk to that you can get the type of financing that you see in central London in central Budapest. So that QE fueled move of liquidity has moved east, and you're now seeing across Europe with the wider macro, which is consistently strong for the first time for probably a decade. The debt and the equity has followed it.
Okay, thanks. Bumsy, in terms of the type of product that is attractive at the moment, full service, luxury, economy, what would you say is currently in vogue at the moment?
Well, I don't know about other funds and what they're interested in necessarily, but for us, I guess 3-4 star business hotel in the city center is sort of what we're looking for. Luxury, the real estate value is really good, but then the value you can extract from the operation is quite limited, and so we don't generally go for it. And then budget, the real estate value is quite low. I think you can extract quite a lot from the operations, but still we want to have some sort of somewhere in the middle. So we generally go for 3-4 star city center hotels, brand, non-branded, it depends on the city. So like for us, if it's in London, Paris, or Amsterdam, we don't necessarily have to have a brand with big chains behind it. But if you're going for another market, then or like slightly secondary location, then we do look for strong brand with a good distribution channel.
So Karim, we're just bringing you back in. If you were given an instruction to try and source a new hotel for a new investor to the market, how would you typically advise them to start that search in terms of what might be a good investment opportunity?
I mean, it depends very much on the motivation, because some people are looking for fixed income, other people are, a lot of what they're looking now for moment is value creation. So people are quite agnostic, I think, to the type of hotel as long as they can actually create some return. So you see people that traditionally would have done city center, but now look at coastal resort because they can see in Spain it's a very big move, but a lot of people would have not considered. There is a lot of interest in alternative accommodation as well. I mean, hostel, as we've seen with Generator and A&O, that's something that people see a lot of value creation in, and clearly serviced apartments. Because if you know how to trade, I mean, from a return perspective, with Brookfield buying Seiko, that's another example. So, I mean, it depends on their motivation. Trophy assets, there is only scarce opportunity, and the number of people interested is not really what's happening. But branding, Italy, there is a lot of things, but it depends on your whole period, how much capital you have and how much return you want to do.
So David, if we're thinking about the transaction landscape, is the UK easier or more difficult than Europe to fulfill a transaction these days?
Well, certainly for UK people, the UK is a known quantity, but that's the problem when you're going into a different jurisdiction. You have to face laws, investment laws, corporate laws, property ownership laws, employment laws that you aren't familiar with, and you have to get your head around. I mean, for major brands, the way to kind of put one toe in the water is typically to do a franchise, and maybe 1 foot in is a management contract, and then both feet in the water is when you actually go in and take over ownership. Just by way of example, employment laws in places like Belgium and France are much more difficult for the employer than they are in the UK, and are much more protective of the employees. You'll find that terminating an employee, even if they're incompetent, can create a massive payout. That's something that has to be faced. And with ownership, if you just go in with both feet with ownership, you're subject to the kind of full, complete array of laws in your operation and development. If you go in, as I said, as a franchise or management contract, you can use your choice of law clause in the agreement to keep it under English law and an agreement that you're more familiar with. So the degree of risk and the degree of is really gets greater the further you go into the investment. And
Okay, no, it's helpful.
Well, I saw it was quite a helpful, I can't remember which law firm it was, but they put out a kind of a football league of jurisdictional risk for creditors. So as a bank, I was quite interested in it. You kind of, in your Premier League in terms of creditor protection, so i.e. bank friendly, you've got the UK and Ireland and Netherlands. And you kind of then go into, forgive the football analogy, but if you then go into the championship, you've probably got Germany maybe, but then you start moving fairly quickly down into the relative Diodora League when it comes to Italy and France and Greece, and I think the point is that for example, Europe is so diverse, is the point that if you're a UK bank going into Europe, from a lending perspective, a lot of it is relatively negative compared to what is your 325-year-old market, your domestic market. Conversely, for a number of banks who want to either invest or indeed lend into the UK, it's absolutely amazing because they've suddenly found they've got a whole range of instruments available to them that in their domestic markets are not there. So, this whole perspective is an important one.
So, Julie, one for you, if you're kind of thinking about the dilemma between an institution and an owner, so I'm thinking Cerberus and the sort of debates that you have on new opportunities or existing opportunities. How do you see the differences between the institutional owner and the, you as a hotel operator owner? What sort of debate happened in that regard?
Naturally, my interests with Cerberus, our key investor and major shareholder, are completely aligned.
Okay, same question for Nick.
Yeah, I mean,
I can answer properly if you want. Look, there's a very big difference if you're a major property investor or real estate investor and what you want out of your investment to what you need to achieve to build out a hotel brand, and that's what you're getting at. But actually there are sweet spots, and what we're all trying to do is build value somewhere. And so what we've got to do is find where we can find the real estate value and the brand value. It's that straightforward.
Because your brand, it might be just worth expanding some of the things, green innovation. How do you seek to differentiate yourself?
So we play to a emerging market, and it's probably the emerging market. I mean, it's the much talked about growth trend in. So the millennial market is. These guys, they're going to make up 75% of the workforce in the next 10 years. They're travelling like nobody's business, and that's driving a couple of major trends, and one of them is the doubling of inbound travel in major gateway cities, which are also incidentally driven by a long-term macro trend towards urbanisation. So we play in very much to that, and but they're also a poorer market. They just are. We know this, it's a fact. So what we need to deliver is an affordable lifestyle concept playing into these emerging urban markets, which is where the demand is, And that is about just rethinking how we deliver our business model, partly. And also, it's a great opportunity to kind of look at all the things that are kind of taken as normal in a hotel and have another think. And so that's largely how we position ourselves, is there a different way to do this? Can we do it better? Can we play to this market better? And can we actually drive out more value from this emerging business model?
We'll come back to some of the technology innovations, but I mean, from the due diligence perspective, Corinne, do you look at, when you're looking at the due diligence and the modelling that they put together, you look at things like the staff costs, the efficiency, the waste management, all those sorts of things? Is that part of the advisory role that you would undertake?
Very
typically?
much. I mean, the revenue lines are probably the easiest sometimes to forecast because you take a view on the market. But nowadays, all the cost pressure that you get, I mean, in the UK and outside, and really understanding the different cost structure, that's a very key element. And still people underestimate it in the UK. Some of them slightly forget about the national living wage impact, and they think about it, let's say, for the next year or so, but they don't see what's going to happen within the next 3 years. It is well known that costs are increasing, so we need to look at people like Cubic that are able to drive some of this efficiency through technology, and what will be the impact on the return. So it's a very big element, is to understand the concept and the operational efficiency they can create.
Okay. Nicola, coming back to your boardroom and your discussion on investment opportunities, brands or independent hotels, what sort of debate goes on there?
Look, I think it all again depends on the supply-demand driver and how tight it is in the city. I mean, I think the value of a brand comes definitely to attract, some markets, like the US market, for example, is pretty attracted by the brands through the loyalty programs and so on. So obviously in big cities, it helps drive these international clients. But frankly, I think in cities like Paris or even London, if you have a pretty good operator, you can achieve as good, if not better, because obviously the big debate on the fees that you get charged and on revenues and on GOP is quite significant. I mean, we currently invested more as a lender, but in a pretty significant portfolio of hotels in central Paris, which are independent hotels. And, the business plan really doesn't contemplate a brand. I mean, some people are, maybe you invest sort of capex, you can bring a Bulgari or Marriott, it's going to help your top line, definitely. But then when you look at the bottom line at the end of the day, which is what matters for an investor, not necessarily the best role. So, again, it depends on also what your exit target is. If you want to exit to an institution or foreign capital, obviously the brand flag helps to get these people over the line. So you may find this in the yield at the end. But from a pure EBITDA and cash flow standpoint, I'm not too sure the brand is always the best.
Yeah, no, I mean, we had lots of arguments one with it or the other. I mean, so Bumji, in terms of the sort of investment in technology, and you obviously look after a lot of managing of the hotels, how do you rank technology as to take brand to one side, but technology, how important is that in your conversations?
I mean, because we're as Invesco, at Invesco, we don't take on management contracts, so it really, we leave pretty much everything with an operator for them to decide what they want to do when they run the hotels. But what I see when it comes to technology is that in-room technology, personally, I don't think it's really good idea to invest too heavily, because it changes so much, and then if you put too much in technology in terms of automating everything, and if it changes, how do you update it in 5 to 7 years? But in terms of tracking, I guess, guest relations, or tracking more revenue management, or increase the cost efficiency, I think it totally makes sense to use much technology, because, as Corinne mentioned, the cost of employees are going up quite quickly, and it will be good to have some cost efficiency from there.
I think there's actually a very interesting analogy in what's going on in the workspace world. So all of the workspace providers in the UK just sort of sat there doing what they were doing, various different levels of competence, don't have a comment on that. What happened was WeWork came in as a technology business, they didn't really position themselves as a co-working provider, and it was very much a technology business. And every single one of those co-working brands now is having to dig deep and respond with a massive technology investment. And that is, if we need to be quite cognizant of that in the hotel environment, and very much as Ramdo was saying, was that why we're so obsessed with putting technology that will be obsolete in a bedroom is completely beyond me. The interesting part is how we use cloud-based technologies, AI, how we kind of redefine our business processes, and actually allow people to self-serve through this kind of communicator they have in their hand. That's where stuff starts to get interesting, and that's what the co-working guys are having to wake up to, and it'll come our way soon, for sure. It already is.
Do you do virtual tours of your hotel for people to review before they book? Because we saw with Thomas Cook, they tripled their sales to New York using similar technology.
Did they? No, we don't do that. But I mean, all of those facilities exist. I mean, you can use your Google Places account to put a video tour up. Yeah, I mean, it's useful. Yeah. Moving images and images in general communicate much better. Yeah.
And what about guest recognition, things like beacon technology or facial recognition? Is that on the list?
Not for us, but actually orientating our business model around the guests rather than others. So another big challenge that hotels have is that we're all driven by the PMS. Oracle is obviously the lead, and the PMS has evolved and developed entirely around the unit of the room. So we talk about the folio, and we talk about whether the room's occupied, sold, what channel it was sold through, revenue per available room. These are all normal things, and no one really thinks to kind of question it, but actually it completely confounds what people's expectations are of a service. So we are the service provider to human beings, and we need to rethink our basic data structures so that they're much more orientated around the customer and as the unit of understanding. So revenue per available customer, for example. Now the challenge with that is our basic database structures don't actually allow for that to happen. And recognition technology is all very well, but if you actually can't connect it back to the customer, it's game over. So we have to start in a much more fundamental place. We have to, through the booking flow and through the arrival process, start recreating our data structures around the unit of human. And then we can start to use this stuff if we choose. That becomes a nice to have.
But it's good to plan ahead, and if you're building a new hotel, plan for that ahead as well. So,
Yeah.
Yeah. So I guess back to Europe, Nicola. In terms of the risks of investing in Europe today, what would you perceive as the main risks of that European investment model?
Well, obviously, as we've seen in 2015-16, there was all the risk around, security and, terrorist attacks. I don't know if I can say it's gone away because we never know. But definitely that's one, and this unfortunately hotels can't really do anything about. You have to suffer the impact. So obviously then means that cities are more exposed. Look, I think the big risk on the hotel side, I think a lot of one thing that people forget on the investment side, and as you've seen from institutions, especially with the flow of capital now in any across market, like more institutions going into hotels, they basically see it as a normal asset class, but it's a business. And we've seen from Julie, obviously, the operator underlying that, underpinning it is key. And do you believe in their model? Do you believe in the way they manage it? Do you? And this is a volatile and seasonal business. So you go in a hotel, even if you buy into a lease, and I'd be quite curious to hear how Invesco invests. But you've seen a lot of actually also institutions going into management contract as if it was a lease. Or even buying a lease as if it was like an office, building with 20-year income to AAA credit. It is not. So, understanding the seasonality and being aware of that is quite key. So that's a risk. And we've seen with the move of, people going, tourists used to go to North Africa, now obviously is moving more to benefiting Southern Europe. But anyone who invested in a resort in Tunisia is probably now, I don't know if there's any, but you have to understand those trends, and you can be heavily impacted as an investor. And I think the next point is supply, obviously. As we see when the market is buoyant, people build new hotels, new concepts. There's the Olympics in Paris coming. We've seen the Olympics. I start hearing people buying land, building hotels. We've seen the story in London. Doesn't necessarily a good story for an investor in a hotel. So I think it's the three things to be mindful of. It's supply, seasonality, and obviously the security and safety of travellers.
There's obviously a lot of political risk, lots of elections going on in Europe at the moment. So in terms of the UK, clearly in the leisure space there's a real shortage of staff, and that's a big issue. How do you see costs in the UK versus continental Europe? Do you see many differences between the structures?
I mean, there are differences, but I mean, wages across, I mean, UK comparatively is not that bad if you compare to Nordics or the French situation. But yeah, I mean, there are differences and specificities to different countries. That's why you need an advisor that understands. You can't take a UK advisor and send them to France and say figure it out, because it's really, really complicated. Also from taxation and the various line items. So yeah, now you need a very good understanding of that. And even in the Nordic, they manage to have really high wages, but they still manage to do good returns. So you just need this type of understanding. So
And also, many of the hotel workers in the continent are unionised, which gives them stronger bargaining position and much more difficult for operators to manage the costs when there's a union in place, and then obviously exchange rate fluctuation between the pound and the euro and various other currencies, and on the continent is also a risk factor, and tax can change very quickly from place to place, and it has a huge impact on investments.
I was had an interesting conversation with a Greek investor going into Spain, and so it was interesting how they were, complaining about the cost of labour in Spain from a Greek perspective. Greece third lower. But equally saying that the Spanish labour market was relatively more flexible than the Greek market, which, from a UK perspective, this is all very interesting. But then saying how, the Spanish revenue tax is more beneficial, so versus Greek. So the analogy, it's so complex because you can look at all these different, and there are pros and cons from each perspective of jurisdiction that you're comfortable with to the jurisdiction that you're going into. And of course with Europe it is fragmented with multiple jurisdictional types. So it's just context really, and I think you've just got to be very, very clear as an investor and lender as to what it is, what's the dynamic between what you're going into and the markets that you're in.
Keeping you in the spotlight then, Tim, so how do you see hotel financing across Europe? Obviously there's lots of investment strategies, and we're talking about sort of equity, mezzanine, senior debt, but how do you see the financing position?
So we've done, as you know, quite a lot over the years. Having said that, hotel finance in Europe remains very much a domestic-based model. We'll probably talk about cross-border deals and all the rest of it, which get all the headlines and are very sexy and all the rest of it. But if you look at the actual volume of deals and the relationships, they are predominantly domestic, because with operating assets, as Nicholas has mentioned, that you've frankly got to be on top of these things, and you've also got to really understand how that particular hotel plays in that particular market. And whilst I might like to think I know London pretty well, I don't really know Budapest as well as I should if I am a lender. And of course, lenders always go back to one of their core principles, which is you should really be lending on your patch, wherever your patch is. And you've therefore got to be absolutely clear, do you really understand the markets that you're in? And with something like hotels, and being a relatively fragmented industry, it has always typically been domestic, been local. Having said that, if you go back 10, 15 years, capital did become a lot more international and a lot more European, and we started, doing and feeling comfortable with transactions in and around Europe. But very much, you then see that the policies of the lenders come into play. So, for example, it might be that you're UK out, so you have a UK lead relationship, but you will fund out. And the analogy I always give is, I was actually funding a hotel is happening in the Brazilian rainforest, but my relationship was 2 stops down the Jubilee line. And I think this gives you the context around how the market has evolved. And I think it's really important because, we fund into a cycle and things change, and it's really, really important from a lending perspective that you've got access to your relationships. And that's why, for example, we would not fund a Romanian investor, not because it's not a good deal, it's just because it's not on our core patch. But I think what's also changed is that the number of lenders and non-lenders into the space has dramatically increased, but also trends like, for example, how the debt capital markets have come into what you would call below investment grade quality deals, very, very good deals, but with but not with a pure senior debt kind of, or indeed junior debt space, but a new, a very liquid market. We can talk a bit about those a bit later on. But the market is still very domestic. You do get cross-border deals, which are great. They are relatively small in number, and the reason is that the market, the markets are domestic for the reasons I've just described.
I'd just be interested on other members of the panel if you've been involved in a development finance of late, because that's a small percentage of the overall lending book these days. It's also quite a difficult sector, so I just wonder what your recent experience is there.
Yes, we have. I mean, I guess it's more like a repositioning. It's like we financed in Rome, so it's development and Rome,
Okay.
which are
Good risk.
good combo, and 80% LTV. So that's
Okay.
But yeah, no, we did finance a developer to convert an office building, former bank headquarter, into what's going to be an Edition hotel by Marriott in next to the U.S. Embassy in Rome. So very strong location, very good operator, who owns a collection of very good assets, but very high and steep, LTV and risk. I mean, I guess basically we underwrote this deal. So we put 60 million in it, but we underwrote it as if it was an equity deal, frankly, for us. So, we believe in the operator, the location, and I guess the business plan. But it's not, it's not anyone's cup of tea. And also we have to go through the hurdle of investing in Italy for a non-Italian investor is tricky.
Is it open now? Is it finished?
No, it's halfway there. So it should open Q1 next year.
What about cost overruns and monitoring? Is that working out?
Yeah. No, that's a topic. I think with Italy, it's not really cost overrun. It's basically the time and the pace at which they work. So it's pretty much when they want.
So it's not just the language; it's we've covered lots of different landscapes.
Yeah, no,
today,
So I think it goes also to Tim's point, which is I think on the lending side, and I guess quite curious in the audience if there's also developers or investors who look for finance, but. You have pretty much in each market a core club, I'd say, of senior lender, like 2, 3, who knows the market, but they know what they can do also. They have a pretty, strict parameters of LTV, debt to EBITDA, given or not. But then what you see now with this wave of capital is you have a whole host of alternative lenders, which I guess we would fall into to some extent, which are willing to take some risk and which are willing to go in higher risky situations, but obviously they cost more, so it's not like a 2%, it's going to be high single digit or sometimes low double digit. So as an operator it may be good because then you put little equity, but you have to understand with whom you're dealing, because these people are kind of, as I said, we underwrote it as an equity deal, so if it goes bad we're happy to do what it takes to recoup our investment through it doesn't mean being aggressive, but it means that that's the way we underwrite things. And then.
So, Karim, when presenting a business plan, do you think the banks are more generous on loan to value, debt service covenants? What sort of structures do you think it's improved from a lender's perspective or from a borrower's perspective? How do you see the current mood music?
I mean, for the moment they're quite keen. There's a lot of development happening in the UK and Europe. They're keen to. A lot of the bank, as you said, there is a club and people are keen to do the financing of the development. I think from what we're asking, however, they're becoming a bit more analytical in the way they look at things. We have more requests for monthly forecasts, for instance, as opposed as before, like really yearly 3-year plan. But now they want a lot more certainty. They want a lot more sensitivity analysis being done, so they can really make sure that when they provide their terms, they have more security. So I'm quite impressed actually with the level of DD they're doing. So you can feel they've learned from the mistakes in the past.
Oh, you're nodding vigorously, so
I know,
you agree?
actually, for us, it's we're doing leases, so the limit, I guess, the information that they're requesting is quite limited. But I heard that they're looking to do a lot more. They're looking for more information, but for us, it's more relationship based. It's very local, and we've been buying quite a lot in Germany, and then we have a very good relationship with German banks. And then I can actually quote the terms. I'm very happy with it. It's about mid-hundred-ish as a single asset. The margin is 70 basis points, and it's 10-year, and it's based on 10-year swap. But then also the arrangement fee is only like 10 basis points. So we're
Don't get carried away. This is not the UK.
And it's 40% LTV, so it's very low leverage. So all that combined, so I know that having a relationship and in the local market, you can actually arrange a good deal.
So to the point earlier, what is it you're funding? Is it a lease? Have you got equivalent of freehold or?
It's a freehold, but it's an operating lease. So we have an operating party who's giving us the lease.
Okay.
I think going back to the development, I think it's either either a big boys game, like institutions who have the capital and don't really rely much on financing, or then you have to go with alternative financing providers. And to tie into Karin's point, I think then the role of advisors is pretty key, because you underwrite it based on forecast and operations, and you have to rely on strong advisors to do that. So.
And that's why it's got a high risk weighting. It's an unknown quantity. It's particularly it's a new build. The conversion is slightly different, but yeah. Okay. I just wanted to see if there's any questions in the audience. Actually, I think we've probably got about 10 minutes or so, David. Have we? Or?
Yeah, as long as you.
Okay.
As you
Okay. I'll take. Oh, yeah. Please.
Can I ask about yield? It seems to me as if obviously central banks are trying to increase interest rates now. That seems to be a trend that will increase. Whereas in the hotel sector, yields are going down. Basically, the hotel sector was perceived to be quite a risky investment. Now yields seem to be going down. Don't you think in the near future, with central government interest rates going up, this trend in the hotel sector will reverse and yields will go up again?
I mean, I would say yes, and I think the yields are much too low, and especially when you look at hotels, maybe they're not lower than normal asset classes, which to my point, I think I don't quite understand. So that's why I think the view of institutions would be quite interesting. But I think what you have in hotels, which supports the investment thesis from investors, is you can basically make up the numbers you want. You know, you make a projection, and when you have a lease, it's a lease, and it's a rent that stays the same. So you buy at a full cap rate, it's going to be a full cap rate. So that's going to be the income. On a hotel, you can say I buy at a 4, but actually I'm going to stabilize at a 6. So it doesn't make me feel too bad because my projections are going to go up. So I think it all comes down to the belief of investor in how much they can drive into the operations, and this, unfortunately, who knows? I mean, it depends on the hotspots, as you said, and that's what you see in hotels. In the hotspots, the yields tend to be low because people believe in growth. And
yeah, I mean,
the question to you,
you're seeing. I mean, okay, rates are starting to increase in UK, but I don't think they're increasing in Europe for a while. At least for the next 24 months. Well, we're not seeing in the next 12. We're not seeing in the next 12 months on ECB rate increases. So it's zero, and you know you're looking at 5-year swap rates in Europe at 50 basis points. So you know if you can get 5-year swapped at 50 bips, it's still looking pretty cheap to me.
We've still got 2 potential rate rises in the UK, so I think
Yeah,
following the US, we're going to see some increases.
Q3 this year potentially, and potentially Q3 next year, but that takes us up to 1%. But again, swap rates in UK are, I think, 1.2 for 3 years and 1.4 for 5 years. So again, it's not exactly expensive. But I do think in terms of what the drives are, I mean, you've just still got this weight of capital out there, and this whole debate about where hotels sit within wider real estate, and it's just such a highly sought after asset class, and that's what investors seem to be saying to us, and that's what's causing this continual, movement on yield, which seems to be down.
I mean, yeah, so it's something that we've been trying to justify in our heads that it's okay to buy at such low yields, because I started my career in 2005, 6, 7, 8, whatever, and then I saw the top of the market. I see like we are getting quite close to the market based on the yield I'm paying for like sometimes in developments it's like 2 years out and the asking is 4.5, and I'm like I'm not sure if I can actually mentally digest that sort of yield, but I understand that the hotel has been I guess a preferred asset classes somehow, or flavor of the month last year, and we have hotel fund that we have actually capital waiting to get in. So it's a good and bad. It's like we're sort of victim of our own success that we've been so happy that we have a lot of institution or pension fund interested in investing in hotels, but at the same time, because competition is so high, that we've been trying to justify in our head it's okay, and then if we have a good location with a good brand or good operator, we can actually eventually achieve the business plan. So that's sort of how we can get to pay for certain certain assets, but it is really, really hard at the moment. I know it's cheaper than fees that we can buy, but still with a lot of pain.
Chris?
The comment I would have on yields is, why should there be a delta on a AAA covenant between a retail investment where you've got all the pressures of the internet and a hotel investment where we've already mentioned that the demand for hotels is going to increase over the next 25 years. I would argue that hotels actually, dependent on the covenant, have historically been massively undervalued relative to other core real estate.
What's your covenant in a hotel?
Pardon?
What's your covenant in a hotel? Is it the operator?
No, the tenant.
So you talk about leased hotels.
If you've got Whitbread Topco, that is as strong as most retailers.
Yeah, but no, I agree. But
exchanging at sort of 3.75 in a decent location,
Yeah.
and no retailers are or very few. I mean, shopping centres at the moment, and anything outside prime shopping centres are anywhere between 6 and 10. So hotels are half that.
Yeah, and I think there's some exuberance in certainly around budget hotel covenants in London, which is driven by the shortage of supply. But the more general point I was making is, when you historically have seen hotel yields at between 6 and 7%, and core real estate yields between 4 and 5%, why is that delta there if the covenants are of equal strength?
Look, I think the parallel I agree. I mean, retail and hotel would be a bit similar, because my view is retail to me is also an operating business. So when you buy a lease and a retail unit, you always use that. Look at effort ratios, what's the footfall, what's the revenues per square meter, which is the same thing in a hotel. So I do agree. I think retail, I still struggle to see why retail has been always
historically
lower. But for office, I think there's no comparison, because office is compared to hotel. Hotel remains an operating business.
I mean, yields are partly driven in conventional real estate by rental growth expectations.
Absolutely.
Now that may be a 6+6 in Italy, 3/4 of indexation, or it may be a 5-year upward-only rent review to market in UK. Hotel leases typically do not revert to market, certainly not in the UK, because there's very little market evidence actually to benchmark. And so I would say that probably the best you're expecting, particularly in the budget sector, is some kind of index linking the rents, if you can get that. Unless, of course, you have a turnover element on the rent. As you do, I have to say, in shopping centres in Italy. So there is a potential upside on that as well. But I do think that there are quite major differences between a retail operation and a hotel operation. And the covenant strength of a hotel company is generally more difficult to assess.
And you think, I mean, the problem I guess on hotel compared to retail, to your point, is in the downtown, you've seen with Jury's Inn, they had a lot of leases. I mean, it's different covenant, but you know, they weren't wrong, and then they had to go and negotiate. They said, look, I'm underperforming on my lease, and that's what I do. Your option is what? Find an alternative operator, which is harder than if you have a high street unit in a good pitch that new look goes bust, and then you gets out, you get a new tenant who maybe has a better covenant. But in a hotel, if I think the view is that
I think that's why the budget sector is such low yields, because it's generally perceived to be easier to find an alternative operator to occupy this box, which can be branded to the brand quite cheaply. It's an interesting topic. I think the area of concern that I have is around the ground leases and what they're going to do to the market in 10 years' time. Because these so-called ground leases, in my view, with indexation for 100 years plus, are going to have real ramifications in the market. And it'd be interesting in terms of you on how you're looking at those from a debt perspective.
Yeah, it's definitely the hot topic, and one which we're going to come back to, I'm sure, over the next 5 or 10 years, because every single transaction that we are looking at right now has got some form of a ground lease element to it. And I mean, we did the Q Hotels deal, refinance, and took a lot of advice around how those leases work, and frankly, we've known Q Hotels as a target for as a business for decades. And we know exactly how they have operated, even whether we've been lender or non-lender to them. And you're starting to take views on diversity of assets and what's in there, and you're taking a view of performance against inflation, operating risk. So we on a larger type deal, we'll take a view. On single asset deals or small deals, and then of course looking at the actual structure of the ground rent itself. And it's difficult because it's a relative unknown. But what we're doing is what's our refinance risk fundamentally at this stage. But it's very, very possible that in a period of time that refinance risk, whether it's at this stage or more likely a decade down the line, that refinance risk will become a bigger issue. And therefore access to liquidity in general, I'm talking about, could make these deals more difficult to finance. But it's the unknown which is the thing which challenges it. But we're seeing ground rent deals on everything, and it's just making it...
So the interesting one, I think, is the big one that's in the market at the moment, which hasn't yet transacted. It's going to be really interesting to see what that transacts at.
Yeah.
We've done similar deals for caravan parks. Health clubs have looked at that particular type of structure, but as Tim said, it's the major operators that we look at. We couldn't bring it down to a low level. But, it's a form of financial engineering. It's akin to opco, propco, getting another turn of leverage, if you ask me. But that's my unofficial view. But,
and to your point around AAA rating on asset classes, of course, in effect, that slither is AAA. That's how they, and they're getting a return on it. But we're seeing it in situations where it's in effect, and you're probably seeing it as well, it's funding the majority of some acquisitions.
Yeah.
And so then there's the question mark around the amount of actual equity going into these deals, which then of course comes very much into our our interest as to who's actually funding these things. Is it got a reasonable equity component, or is it predominantly debt, ergo opco propco from 10-15 years ago?
Any other questions? I just wanted to canter down the panel and see if you had any top tips or innovation suggestion or things that might be topical, or how an operator could look at things differently in 2018. So maybe Kareem, we could start by going down the line from you.
Okay, good morning. No, I mean, for me, I think 2018, I think for people is being open to various markets, because based on the performance in 17, a lot of markets still offer opportunity, I think, and people need to look outside of some of the normal territories because there are opportunities, but you need to be open. And the other thing I would be careful of is on the business plans, because for the moment people just have an exponential increase everywhere they go. They never think about any potential downturn, which has impact on your ground rent, on everything. And a lot of the debate that we have now is about being realistic on business plan. Don't think that, you know, everywhere you go the next 3 to 5 years will be the same, perfect.
Yes.
And your exit will be even better. So we have a lot of debate on that when we do DD. So I think that's my key worries, I think, at the moment, is being realistic on business plan.
Wise words, thank you. David?
Yeah, I think with Brexit's impact on the hotel industry in the UK, there is going to be a lot of interest in looking at the continent as an alternative, and we could see with the growth markets, with the growth in some of these markets, there is some real excitement and investment to be done. I would urge, as I mentioned before, to take it slowly until you really know the market. Go in with a franchise or a management contract that you can control much better, and get it until you really go in and make a property and operating investment in a jurisdiction.
Thank you. Tim?
Yeah.
Well, I think the good news is there's plenty of liquidity around Europe for hotels, and the macro environment is positive. There is the usual question surrounding where we are in the cycle. I would, just pick up on alternative funding for hotels. I'd pick on 2 examples, one of which is a very small advertisement for us, but first of all, if you look at Generator, which was refinanced just before Christmas, €250 million deal which HSBC and SocGen did across 8 jurisdictions. Sold it, and I think it just goes to show that the liquidity is out there for these complex cross-border European deals. As I said, 8 jurisdictions there. Liquidity is there, and that was a great deal. In the same sector, we funded A&O Hostels, and whereas Generator was a bank deal, 2 banks, as I say, HSBC, SocGen, big tickets each. We did ours via the debt capital markets. It's a €300 deal, 4 jurisdictions, but in the debt capital markets. And I think trend-wise, if you look at the States, they are 70% debt capital markets, 30% core bank debt is typically how things are structured. Europe, it's the other way around. So 70% bank debt, 30% debt capital markets. You can see on larger transactions a trend increasingly towards debt capital markets over time.
Thank you.
For me, well, I know that there are some other opportunities in some other markets, but for us, it's investing in a prime location in A markets is key, especially when you're expecting top B market. So for us, that will be our focus, and then having a right business plan without expecting too high of an increase in your performance, and sort of not to be optimistic on your exit yield. We had a lot of debate on exit yield in one of our recent deals, so not to be too optimistic on exit yield.
Thanks. Julie?
I think it's my top tip would be to focus on quality, and I take this from a variety of different environments to start hotels. People who are really getting a good job done, are focusing down on delivering a really strong operating model, brand position, business plan, etc., etc. They will thrive through the inevitable ups and downs. And we've seen it in retail, we've seen it in in all sorts of different environments, those guys who are really focused on getting things right will win, and will come through all them. What will be seen as relatively minor ups and downs on a kind of 10-year horizon. It's a long-term game, and you need to be doing it right. So I would be very wary of any business plan that just talks about taking out cost, and talk about a business plan that talks about reworking, your business model and your way of doing things, because I think that will be what keeps everybody alive and putting bread on the table.
Yeah, that strong feedback is self-perpetuating, isn't it? It's very powerful. So, Nicola.
Yeah, look, I guess my message would be along the same line, would be a step further, which would be more caution, I'd say. Today, I think hotels remain seasonal. I think the tide is very high, so everything looks very rosy. But when the tide goes back, then you realize all of a sudden where the issues were. And I think be mindful of the trends too. I mean, you look as I think there's some pretty structural trends which are changing the industry, and with the right operator, which is going to thrive. But anything starting with a co something, e something, or micro something is not necessarily, where investors will want to be in 3-4 years. And I think also watch more on the operational side, the disruption coming from all the big Google and so on, which are coming with a lot of disruption on the booking systems and the way people use hotels.
Yeah, thank you, and thanks to our panel today. David, in terms of hosting today, thank you very much.
And Mike, thank you very much for moderating. You did a great job.
But people can stay and have a coffee if they want.
Absolutely, and food as well.
Thanks, everybody.
Thank you.